Welcome to the deep dive. Today, we're plunging into something, well, pretty monumental, really. It's the accelerated push by BRICS nations to rely less on the US dollar for trade and finance. We've got some fresh source material right from today, August 8th, 2025, that details these big shifts. So our mission here is to really unpack what de-dollarization means now in 2025, why it's picking up so much steam, and, what the surprising fallout might be for the whole global money system.
Yeah, and what's fascinating here is just the range of things happening all at once. You've got Russia planning this new independent gold exchange, which is, well, a very direct move. Then there's record Chinese gold demand, and even this quieter trend of central banks buying gold straight from their own miners. It's a lot happening, all pointing in a similar direction.
Okay, let's unpack this term then, de-dollarization. Most of you listening probably know it, but just quickly. It's basically the process where countries actively, systematically try to use the US dollar less. Less in trade, less in finance, even less in their, national savings, their reserves, moving away from it as the main global currency.
Exactly. And it's not just talk, right? It involves some complex methods. We're seeing more bilateral currency deals, countries trading directly in their own money, plus the development of totally new payment systems to sort of bypass the usual routes, and definitely more use of things like gold for settling international accounts. Historically, this isn't totally new. If you look back, the British pound used to be dominant. Its decline after World War II shows that, well, these things can change. Reserve status isn't forever. It evolves.
Right. And for you wondering, how does a currency get to be the reserve currency anyway? Economic theory points to a few key things. It's about economic size, political stability, how deep and liquid the financial markets are, and really importantly, international trust in institutions.
So shifting to BRICS specifically, that 17th summit in Rio, that was quite a significant milestone for their financial independence goals. It really built on talks from the Kazan summit back in October 2024. That's where they started mapping out things like the BRICS pay system, to help members trade using their own currencies.
Okay, here's where it gets really interesting for me, maybe a bit unexpected. The members in Rio, they talked explicitly about moving away from dominant reserve currencies, that's the phrase they used, and pushing instead for deals based on their own national currencies, their stated goal. Less dependence on traditional Western financial infrastructure. It sounds like a united front, but is it really? How unified are they on the how?
That's a great question, and it reveals something quite nuanced. The goal might be shared, but the approach is pretty individualized. Take Brazil, for example. During their 2025 presidency, they've really focused on promoting local currency trade deals, not so much pushing for one single BRICS currency. That reflects, practical issues and respect for each member's monetary control. India, too, has been clear publicly. They say it's not about weakening the dollar per se. It's more about gaining financial autonomy, reducing exposure to, say, U.S. Federal Reserve decisions. So this individual nation approach gives them flexibility. Each country moves at its own speed, trying to avoid big economic shocks. It's more about resilience, maybe, than direct confrontation.
Okay, so building on that, the different approaches from Brazil, India, let's look at Russia. Their strategy seems particularly, well, bold, especially on gold. They've got these concrete plans, launching gold trading on the St. Petersburg Exchange by year-end 2025. That's a direct shot at the London-centered system, the LBMA, right? The London Bullion Market Association, which pretty much sets the global gold price benchmarks. Russia wants to disrupt that. And it matters because Russia is, the world's second biggest gold producer after China.
Yeah, exactly. And this raises an important question. What's the main goal there beyond just challenging London? They've said they want to create a competitive market price for gold separate from those traditional benchmarks. And this comes after years of, let's say, criticism, even legal action against traders over suspected manipulation in metals markets. So there's a context. What this new exchange allows is for Russian gold buying to directly influence the global spot price, something they couldn't really do effectively back in the Soviet era. It's about getting a seat back at the price-setting table for a key asset.
And it's not just the market, is it? Russia's also focused on the physical side, holding the actual gold. That's interesting. Unlike lots of countries storing gold in London or New York, Russia keeps its reserves at home in domestic vaults. They see it as, giving them more direct control, making them less vulnerable to sanctions or having assets frozen. Russian officials literally call it an important step towards de-dollarization and financial independence from currencies from unfriendly countries. It's like building economic defenses.
Precisely. And it's a strategy, frankly, more governments might be thinking about, given how finance has been used as a tool or weapon recently. Now, looking broader globally, World Gold Council data shows something pretty striking. 53% of central banks that have local gold production are now buying directly from small scale miners. That's up massively from just 25% last year. You see countries like Colombia, Tanzania, Zambia, Mongolia, Ecuador, the Philippines all doing this. And the reasons they give: lower costs, boosting domestic refining, getting discounts on direct buys, and interestingly, fewer international reporting rules, a bit more discretion, perhaps.
And it's not just buying, it's where they're keeping it too, right? The storage is shifting. In 2025, 59% of central banks said they store gold domestically. That's up from 41% in 2024. Although, interestingly, the Bank of England is still the top spot for those who do store abroad. 64% of them use London. But that domestic trend is clear. Now, China. We have to talk about China's role. It's pivotal and, frankly, kind of jaw-dropping. The first half of 2025 saw just unprecedented activity in their gold market. ETF demand, that's exchange-traded funds, shot up about 400% compared to the average over the last decade. Wow, 400%. That's huge. And this massive buying spree is seen as the main reason gold prices have climbed so much over the past 18 months. It's really shifting the market center of gravity.
Yeah, what's really fascinating here is how this marks a fundamental shift in global demand. Historically, big gold rallies, bull markets were often driven by Western buyers, Western sentiment, but now the current dynamics clearly show emerging economies, especially China, taking the lead in setting the price. This arguably improves global price discovery, makes the market deeper, and ultimately means Western influence on gold prices just isn't what it used to be.
So the flip side then, how is the U.S. reacting to all this activity?
Well, the Trump administration has responded pretty strongly, actually, with trade measures aimed at BRICS. They've announced 10% tariffs on all BRICS members, and there are reports suggesting threats of much higher tariffs, like 100, even 150% if these de-dollarization moves keep going. The administration frames these BRICS actions as deliberately targeting U.S. economic interests. Okay. They've described the group as set up to hurt us and designed to, quote, degenerate our dollar and take it off as the standard. Right. And if we connect this to the bigger economic picture, well, standard analysis suggests tariff costs usually get passed on to domestic consumers, businesses, meaning Americans likely pay more. So this kind of approach raises worries about, potentially slowing down global growth, creating more uncertainty for businesses. And you have to wonder about the strategy. While it's presented as defensive, historical research does suggest trade restrictions can sometimes escalate things, potentially leading to broader conflicts. Less economic cooperation often means more geopolitical friction.
Okay, let's try and pull all these different threads together. What does this all mean for the global financial system? It really looks like these developments signal a potential move towards maybe a multipolar monetary system, challenging that dollar-centric setup we've had since the 1970s after Bretton Woods fell apart, the system that really cemented the dollar's top spot.
Indeed. And the rise of these alternative trading systems, alternative pricing centers like the Russian gold exchange, it could genuinely reduce the control Western institutions have had over the plumbing of global finance. What's interesting is that more competition between financial centers usually leads to better price discovery, maybe less room for manipulation. That's a potential upside. It kind of mirrors history, where financial innovation often comes from competitive pressure. Now, expert views differ, of course. Some economists see it as a natural, maybe even healthy evolution towards a more balanced global system, potentially more stable in the long run by spreading risk away from just one currency's policies. Others worry about instability during the transition. It's bumpy. And you absolutely have to see it in the geopolitical context, too. These financial shifts often mirror bigger power shifts, and their strategic responses to things like sanctions, central banks diversifying. That's just pragmatic risk management in this environment. Hedging their bets, reducing reliance on any one system.
And we should remember, these new systems face hurdles in the short term. Big technical challenges, regulatory issues. Whether markets actually adopt them really depends on if they prove reliable, convenient for businesses doing global trade.
Exactly. Looking further out, long term, the potential emergence of a truly multipolar monetary system that could fundamentally change how global trade gets settled. A transition period might be volatile, involve coordination problems as markets adjust, but multiple reserve currencies could, theoretically, offer more stability by diversifying systemic risk. Ultimately, though, the dollar's ongoing role probably depends on things like relative economic strength, policy stability here in the U.S., and whether these alternatives become truly credible and widely used.
Wow, okay, what a deep dive that was. We've covered a huge shift unfolding in global finance, driven by BRICS nations, with gold playing this increasingly central role. And these aren't just, abstract theories. These are concrete actions with real global consequences. So here's a final thought for you to chew on. If reserve currency status depends not just on economic power, but fundamentally on trust, how might today's shifting geopolitics, this drive for financial independence, affect the very foundation of trust needed for any new global financial systems to really take root and offer stable alternatives for the long haul?